Good morning and welcome everyone to the Coinbase Institutional Markets Call. I'm Dave DeWong, Head of Institutional Research. I'm filling in for Ben Floyd, who I'm sure is off right now, just thinking about all the ways to retool this podcast and make it better because that's the kind of work ethic he has on vacation. In any case, we are back to 70,000 on Bitcoin. We have that to cover alongside Ethereum L2s, EigenLayer, liquid restaking tokens. George's going to run us through some of the market headlines. Greg is going to go through the flows. But before we start, just remember to subscribe to our podcast, check out our research. There are links in the show notes. That's all I'm going to say on that. But right now, I have the pleasure of introducing Ben Rodriguez, who's our Senior Protocol Specialist. He works in Coinbase Cloud. Ben and I have actually hosted a ton of events together. We've talked about a ton of different protocols. But this is actually going to be our first podcast together. So depending on the strength of this episode, we may go out and actually start our own podcast someday. No promises. Ben, welcome to the show.
Hey, David, appreciate that. Thanks for having me. And I so look forward to the day that we can start our own podcast together, become podcast bros.
Love it. Quick introduction to yourself, because I think you can do it justice more than myself. Could you just give us a little background on how you kind of got started in this? Quick intro on what is Coinbase Cloud? What does that team do?
Yeah, absolutely. So I'll give a quick background on me and how I got here, and then I'll give a quick background on Coinbase Cloud. So name's Ben Rodriguez. You probably have heard me a couple of times on this podcast, just hosting other protocols, stuff like that. I'm Senior Protocol Specialist on the Coinbase Cloud team. What I do is I do a lot of I'm at the forefront of the technology, specifically trying to do a heavy research and help try to influence some of our product strategy, give suggestions to product and different teams in terms of how we can orient ourselves in a crypto native way as we move towards an on-chain world. Right. So, I do a lot of research. I connect with a lot of the communities, different ecosystems. Specifically, the ecosystems that I cover are Ethereum, the L2 ecosystem. If you want to package it all together, it'd be like the modular ecosystem. So I also do cover Celestia, for example, right? And a whole host of other protocols as well. What Coinbase Cloud is one of the top operators in the space. Being able to, host validators for anybody who wants to participate in the staking economy. There's a bunch of different things that we do in terms of dev products and all that fun stuff, but we mainly focus around our node infrastructure and stuff like that. So, that's kind of a short background on Coinbase Cloud. Me, I've been in crypto for about 10 years. In November of 2023, actually, has been my 10-year anniversary in crypto, where I purchased my Bitcoin. I have a background as a software engineer. I was in TradFi for a bit, and then I switched into product for a little bit. And then I came to Coinbase as a protocol specialist. So, that's a little bit of a small background on me.
That's great. And I want to underline the point you made earlier, you're a specialist on Ethereum. So if we're going to talk about a very Ethereum heavy show today, don't blame us, blame Ben, because that's his expertise. But we want to double click on that because that's, I think, super important, especially right now, because, we're seeing the Ethereum L2 landscape in particular kind of shift post-Dencun, right? It seems like there are just a bunch of L2s taking advantage of how cheap and kind of easy it is to kind of launch L2s. Some of these, by the way, look like just totally fraudulent projects. But at the same time, there's just been a lot of activity, probably due to meme coins and other things. But can you just kind of walk through that, Ben? Just on some of these L2s, I'm thinking base, there's just a lot of congestion-induced fee volatility. What are your thoughts here?
Yeah, absolutely. And also, just to preempt it, right? We will be talking a lot about Ethereum and all the L2s, stuff like that. Especially, I'm the specialist on that. But we're going to touch upon Solana. We'll get to that in a bit because there is actually a lot of fee volatility around there as well, and congestion, right? So, but let's talk, address what you're talking about in terms of the L2s post Dencun, right? So, I think I want to make a point that it's only been about 13 days or something like that post Dencun or something like that. I want to make a point that not all L2s have migrated over to Blobs yet, and not some of them are not using Blobs using it just to the max capacity just yet. This is going to happen. More and more L2s are going to be using Blobs in the next couple of weeks, right? So the market for Blobs in general has yet to fully materialize and mature, right? So speaking to base a little bit, right, regarding the fees being high, and this would be applicable to L2s, other L2s that are experiencing high transaction fees. Since 4844, there has actually been an increased demand on L2s such as base. Base specifically has seen really high induced demand. And base has actually reached its target gas capacity, right? So gas being the unit that measures the amount of computational effort to run required ops on the network, right? So they've reached a target capacity, but demand has just continuously increased. So data fees from Blob specifically actually remain pretty low because of 4844, which those specifically haven't reached capacity. Okay, so I want to make that very, very clear here. So then the thing that I want to go into is okay, well, what's the potential solution here, right? So the solution would be the simplest thing right now would be to increase base's target capacity. It's simple to say, but we have to think about the potential ramifications of doing something like this, right? So this would be increasing the throughput of the chain. This would be actually increasing the load on the sequencer and the node infra, right? Which is fine to a certain extent in the short term, right? But in the longer term, this leads to potentially faster rates of state growth, which actually has to be taken into consideration here, since this is literally a whole thing to figure out on the Ethereum roadmap. They're for that, right? But for now, I think before we go deeper into that, right? I think we just need to level set on there's that congestion comes from the fact that that the target capacity, the target gas capacity, they need to start thinking about increasing that. But blobs themselves have not reached capacity just yet. And going back to the previous point that I said, we're gonna wait maybe a couple weeks, maybe even a couple months in terms of how this blob market is going to materialize.
So let's kind of roll it back a bit, and we've mentioned blobs on this podcast before, but I don't expect everyone to just kind of be listening to us all the time. So maybe I've given the intro on blobs. It was terrible. I think you could do a better job. Why don't we start with a definition of blobs first, and then kind of talk about data availability as well, which is a whole separate concept, but related to this. Maybe let's start there, and talk a little bit about how to think about those two separate concepts.
Yeah, absolutely. David, you really sell yourself short, my man. But okay, so let's actually recap what blobs are, right? And what 4844 was, and then we'll get into data availability and other data availability layers, right? So back in 2020, let's go back to, let's go to a story and whatnot, right? No, but back in 2020, we had the advent of the roll-up centric roadmap, okay, right? And I think people know that, it's been alive for a while. That's why we have the L2s that are being built right now, right? But L2s have their own scaling issues. They're about as scalable as the L1 is able to process the data that comes from the L2. So we'll return back to that in a sec. So blobs specifically are a new type of transaction, right, that can enhance the way data is handled and processed on Ethereum. Ethereum can accept these blobs of data, right? And they were persisted on the beacon chain for a short period of time. In addition to that, right, there is a blob fee market that ensures the blob space is used efficiently and remains economically feasible. So blob gas, quote unquote, is itself a new type of gas that is independent of normal gas. And for now, blobs are the only things that are priced in blob gas, right? So that's kind of the main thing here, that blobs are a specific type of new transaction in the way that data is handled and processed on Ethereum, right? So the thing is, right, let's actually go a little bit deeper, right? Specifically, there is a blob cap per block, right, that can start on the lower side and can grow over multiple network upgrades. I don't have the numbers off the top of my head, right? But the idea is that we're kind of trying out this market right now, seeing how it flows, seeing how it goes, right? And there's going to be potentially increased blob capacity in a sense, in different upgrades, right? Blobs are short-lived, as I mentioned before, and will be pruned after about 2 weeks. They are available long enough for all actors of the roll-up specifically to retrieve, right? But short enough, time so that disk usage is actually much more manageable, right? For example, optimistic roll-ups, such as the optimisms of Arbitrum in the world, right, will need to provide the underlying data, right, that we're just talking about for as long as the fraud challenge window is open, right? They're usually around 7 days, right? For ZK rollups, that's a little bit a little bit more involved. They would provide like more things here. We don't need to go that deep into that, right? But the whole point around this is that before blobs, right, data was persisted in and used specifically into call data, which is persisted forever and is actually much more expensive to use, right? So that's why there's this and I mentioned, right, like, you know, the L2s are about as scalable as like the L1 is able to process the data that comes from it, right? So like, because cold data was so expensive to use, we needed this kind of solution, like a new blob type of transaction, to be able to like, make this much more cheaper, much more efficient, to be able to for rollups, right? So the thing here then, excuse me, is to make a main point is that blobs are actually a step, right? It's called proto-dank sharding, right? They're actually, it's a step on the way to full dank sharding on the roadmap, in which now we get into data availability to make Ethereum a better data availability layer, right? But the thing is, blobs are just kind of this like intermediate step to full dank sharding. And like, full dank sharding can take some time. So then now this goes into, take some time to implement. So this goes into alt, quote unquote, data availability layers, right? Because like the thing is, 4844 is not really the end game, right? And there's more things to be built to make Ethereum like, a very like good data availability layer, right? It's a stepping stone. So the thing is, these other alt like, DAs, right? We hear about them all the time. Celestia, EigenDA, Avail, Near DA, right? There's probably others that I like, can't think off the top of my head right now, right? There is like kind of this like bet where it's like, well, for now in the short and medium term, right? Like, we have yet again, I mentioned this earlier in the previous question, the market for 4844 has yet to fully materialize. And then the question that then becomes, right, especially like dank sharding is like kind of like the full scope of how we're thinking about it, right? Is 4844 going to be enough? Right? Is this something that will reach like its inflection point, as this bull market continues and more demand on these networks happen, right? So then the bet that many of these alt DA layers is like, well, we're scalable now. You could use us and achieve like like throughput and like cheapness to a level that would be good for like a strong bull market, which it seems like we are like in or kind of headed towards and stuff like that.
I mean, like, I think there's a few misconceptions that are embedded in these things. I mean, even among people who deal with this stuff all the time, because I have trouble just trying to figure out, are blobs and these data availability layers you mentioned, like, EigenDA, Celestias of the world, are these two things complementary or competitive? Because in practice, they serve different functions, right? Like what you just explained was blobs help optimize data storage, whereas these data availability layers themselves, I'm just going to say DA because that does not roll off the tongue. These DA layers, they kind of help prove that the data itself exists. But theoretically, they both kind of get these L2s to where they need to be at the end of the day. It just feels like a lot of people attribute blobs as inheriting their security from Ethereum, so they seem more secure. What do you think? Are blobs just another horse in this race, or are they going to be, quote unquote, like the solution for L2s eventually when you have full dank sharding?
Yeah. So, I mean, that's how we figure out, like, that's where the market is going to come into play, right? Because like, technically, really, like, if you're using EigenDA or you're using Celestia, right? Like you're not using 4844, right? So, however, there is like, just to make a note, like Celestia has like a fallback option for like, if their DA layer is like not necessarily like, it's not working or whatever it is, right? Like there's some issues with it. It falls back to actually Ethereum mainnet 4844, right? So, they are competitors to each other, right? Like, the idea is that, oh, well, you could use an alt DA, right? And rollup can just use an alt DA, right? So, and going back to like the whole storage, right? Like blob storage is 2 weeks. So if you're using that for long-term storage for whatever reason, it's not going to be really good storage, right? So this is specifically for the blob market and to be able to persist data long enough for rollups to be able to use, right? So how the market materializes where there's going to be potentially choices, design choices. And this is kind of like the whole modular aspect of the ecosystem where it's like, okay, well, you can kind of like plug and play many different layers and different things. Like, for example, right, we have like SVM, like the Eclipse SVM and stuff like that, as for execution layer, stuff like that. We have data availability like solutions and whatnot. It's almost like plug and play in terms of like the specific functionality of what like, a blockchain is to many different like, specialized functions, right? So this is how we're going to see over the next like, X amount of months, X amount of years, how this will eventually play out.
Ben, thank you for that. And I come from a trading background, not a computer science background. So this all sounds, to me at least, very complicated. But I think the takeaway is, Dencun and 4844, really makes the chain better for L2s. And I guess if that's the case, again, coming from a trading background, why do you think we haven't seen more of a move in some of the L2 tokens? Yeah. Or more of a rally in the L2s?
Yeah, absolutely. And I think like, when you say like rally, right? It depends on what you mean by rally, right? If we're talking about increased usage for L2s, right? I mean, base has been rallying for a while, right? So that's like, it's something to think about, right? So when we talk about like actual usage, right? Like, it's congested right now. Some of the L2s are congested. There's high transaction fees. That is, in my like world, that's actually like a rally in itself, right? If you're talking about blob usage in terms of like, L2s, like, rally and stuff like that, right? It's actually a function of when all the L2s, as I mentioned before, are actually using blobs and seeing how the blob market shakes out, right? So a lot of L2s are not fully on blobs yet and are actively switching. So then we're actually kind of seeing, in my opinion, kind of a little bit of a potentially market lag in that portion, right? When all L2s are on, what do you call that? When all L2s are on, on blobs, excuse me, then we could see when the market materializes and then see maybe even more of a rally that we're thinking about. But like, it really does depend on your definition of rally, but I think the rallying has already been happening.
Interesting. So it sounds like what we may be seeing in the token price may not fully reflect the fundamentals and what's actually going on some of these L2s.
Correct.
No, it's awesome. So, one of the things that seems to be driving activity right now is just meme coin mania, right? And it seems like it's kind of a two-horse race between Solana and some L2s. I'm going to say it's mostly base. But, transactions are dropping and failing on Solana. Priority fees aren't quite working. Like L2s like base, people say they can guarantee transaction landing, but I don't know if that's necessarily true. It can definitely get expensive even after Dencun. So it seems like these networks are getting stress tested. Like, what do you think the scalability roadmap kind of looks like for base versus Solana? And what do you think are some of the trade-offs there?
Yeah. Bear with me because this is a very involved conversation. I love this. So would you please also pause me if I you need to ask other questions while I'm talking about this and stuff like that. So to preface, right, this actually demonstrates that we're not ready for mass amounts of usage and adoption yet. And that's not to say I'm bearish, by the way. This is actually a much bigger bull signal for me, right? It's quite the opposite, where I think that we're discovering where the boundaries are and where different teams and ecosystems are working to evolve so that we can eventually handle 1 billion users, right? But you can see that there's we're not ready for mass adoption yet. And that's not a bad thing, right? It just shows that it was going back to the meme economy, right? The meme coins and stuff like that. I know there's a lot of folks that are kind of dejected about it and whatever, but this is actually good in terms of understanding usage and the boundaries of which each all the specific networks, whether it be Base, Solana, right, where the boundaries are in terms of actual network usage, right? And then we could evolve that way. And memes are culture, and I know people disagree with the idea behind a lot of these things, and you do need to be careful when you're participating in this, because funds are always at risk in terms of that, right? Especially you don't know what these memes are and stuff like that. So preface that to be careful. But this goes into the fact that if people perceive value, think something is valuable, then it's going to be valuable, right? Whether it's Pokemon cards, whether it's whatever, meme coins, NFTs, whatever the case may be, right? This is people will want to trade this or have value on it and stuff like that. So went on a little bit of a tangent there, right? For Base, I mentioned it earlier that like that what they're exploring right now is is increasing the gas target, right? Then we get to see how blobs do for Base and other L2s. And there are many different avenues in which to achieve scale on Base, right? As like on the Base side of the equation, right? So I mentioned before, are blobs enough? Or we're going to have to revisit that, later down in the pipeline, right? Excusing the whole ETH alignment meme and stuff like that, right? Are blobs going to be enough, especially during a potentially like a bull market, right? Is alt DA needed to achieve certain goals for any of these L2s, right? And then also we have to think about compute, right? The execution layer, right? We're seeing this experimentation with many different L2s, like VMs being built on L2s, Move VM, SVM, all that fun stuff, right? And we're starting to see the experimentation of these things right now. So there are many different avenues in which we need to think about in terms of scalability, right? And as we reach those avenues, we're going to have to be able to think, what do we what's available, what needs to be done, and stuff like that, right? So we are still in a state of completely evolving, and as we're at the forefront of this, right? And the answers now that I've provided, answers, quote unquote, right? May not be some answers in the future, right? There might be something different, in terms of this, right? There are many different, really galaxy brain people thinking about the many different ways that we can get this to 1 billion users, right? So, and then, we're talking about now Solana. And I want to preface this, okay, that I am not the Solana protocol specialist. Shout out to Andrew Allen, who does amazing work on Solana. I myself, I love Solana. I'm a heavy user of Solana, right? So, and I do appreciate and love what they do and all its merits. But I will do my best to provide a representation of their scaling roadmap, as well as what's currently happening in terms of Solana transactions. Okay. So I believe this is something that everyone can relate to. I believe also Mert used this as an example, right? When we think about transactions, a lot for the folks that are non-technical, right? You can think about, let's actually talk about websites. It's actually, maybe the usage of Twitter, the usage of, whatever, Google or whatever it is, right? Or even on the Coinbase website, right? The thing here is, in the traditional Web 2 world, right? How we think about this, how data comes from servers, right? There's something called this request response cycle. So whenever I go on google.com or coinbase.com, x.com, whatever it is, and I press enter, right? My computer or my laptop, my iPad, my phone, whatever it is a client in which it's requesting information, a response from a server somewhere that hosts these websites. So when you get to when the client requests from the information from the server, right, and it's all good to go, you put the website in correctly, all that fun stuff, then you get a response, and usually that's there's specific status code that most people don't see, right? It's 200. There's a successful response, you get it back, right? So you made a request, the client makes a request, the server responded successfully, we're good to go, right? There are a couple of other things where, for example, when a website is down, right, where you try to request information from a server, you get a response, maybe the website is down, whatever the case may be, right? You've seen this happen before on many websites, right? That means that the server has a problem with it. There's usually a response that goes with it. Usually it's in the 500s, whatever it is, 500 saying, oh, sorry, there's something wrong with the server, right? And then there's also for example, if you made the mistake as the client. So for example, if I put Coinbase.com and then put a bunch of gibberish behind the slash where it's XYZ or whatever it is, and that doesn't actually go anywhere to the Coinbase web app, right? It'll be a 400 response. You've maybe seen a 404, page not found or whatever the case may be, right? So this does happen, right? And when you see something that failed transactions on kind of Solana or whatever the case may be, right? You kind of see some similar scenarios that plays out with the transactions as what I explained with traditional Web 2, right? So for example, if the chain process the request successfully, but there's like something with the smart contract that receives it saying, oh, this actually the request is not good, right? There could be many different reasons why that might be the case, right? So you may not be calling the smart contract with the right permissions, right? You don't have the permissions for it. That could be a bad request to the smart contract, right? If you are the markets have moved, for example, especially with a lot of things going on in the markets right now, right? And it have maybe exceeded your slippage tolerance, right? That would be another thing that could be an issue with the smart contract, right? And the smart contract would be nope, sorry, this request is not good or outdated or whatever the case may be, right? Or another thing that is kind of familiar to Solana is, and just in general, in different ecosystems that are very popular, right? Bot spammage, for whatever arbitrage or whatever the case may be, right? So just to make sure to people understand that maybe the transactions didn't land, right? You might need to do them over again, but that doesn't mean anything wrong with specifically with Solana, right? So there is a little bit of overload here where people think about failed transactions, right? So it means that their transactions are not successful, and there might be reasons for that specifically.
Thanks so much, Ben, for breaking that down. Super interesting, and love the comparison there on the scalability. One other topic that I'd love to hear your thoughts on, and that keeps coming up a lot in the space, is yield generation, and more specifically EigenLayer in that context. So let's pivot a little bit to that maybe. And perhaps to start, you can explain EigenLayer and how it works in layman's terms. And after that, maybe we can drill a little bit deeper into some of the misconceptions relating to that.
Yeah, absolutely. So, when we think about EigenLayer, right, one of the things that I there's a lot of people that try to really understand what EigenLayer actually is. And the idea here is that, I like to use the example of sidechain. For example, right? You build a side chain, right? There's a two-way bridge to the side chain. Maybe it's towards for Ethereum or something like that, right? But that side chain is completely independent. It has its own consensus model. It has its own economic security budget, right? It might secured by X amount of stake or whatever it is, right? And the thing about it is that if it doesn't have a high economic security budget, it is obviously not very secure in terms economically, right? So the idea of EigenLayer is saying, well, hey, actually, Ethereum has right now, what is it, 100 billion in economic security, stuff like that. It's secured by 100 billion bucks, right? Why can't we just use that so that we can build other services? Because the thing is with EigenLayer, right? It helps with these crypto cold start problems, right? As I mentioned, right, where it's an economically secure validator set, the validator set in general, bootstrapping a validator set, as well, right? But also the economic security of that validator set. EigenLayer tries to tap into that and says, hey, Ethereum has all of this economic security, right? We're going to build the architecture on top of it such that you can reuse this economic security, right? To be able to bootstrap services, also called AVSs, actively validated services, is what EigenLayer calls them, so that you can jumpstart from the crypto cold start problem and be able to actually leverage the economic security of Ethereum to build these services. That's kind of the long and short of it, right? The thing about EigenLayer, right, that people tend to think about these things is there's maybe potential risk factors regarding it, right? So before we get into that, what do you call that? Did we have any questions on terms of EigenLayer itself and what it does for the ecosystem?
Yeah, actually, I wanted to put a plug in for you because I think you had a pretty good fireside chat with Sriram, who of course is the creator of EigenLayer. I think that was back in late January. So for anyone who hasn't watched it, I think it's available online. We'll put it in the show notes. But I think that, just kind of even just a bit of a more of a further breakdown in terms of AVSs or actively validated services, just because I don't think people really understand what is EigenLayer trying to secure and why we need this at all.
Yeah, absolutely. So, I use the word reuse, right? The idea of here's this ETH that is being staked, right? how you're staking it, doesn't really, like, we'll get into that in just a sec, right? But like the thing is, like, there is, that like ETH that is there that can be potentially used for more, right? So the thing about it is that, like, as I mentioned, what EigenLayer does effectively does three things. All right. One, it reduces the bootstrapping cost of building protocols or apps that would need this economic security, right? They don't need to worry about the crypto cold start problems, as I mentioned, right? And like being able to bootstrap and coordinate a validator set and the economic security of that validator set. Two, right? Like, so this is for like AVS builders or protocol builders and stuff like that, right? So now two, right? We're talking about the stakers, right? Let's talk about why stakers might want to use or like be able to participate in restaking, right? Well, look, the reality is we like yield, right? Everyone likes yield. Hopefully when people actually try to like figure out where they get their yield from, right, that they know that whatever they're using, like, they know where that yield comes from, right? And the idea here is that these protocols, right, will be building out useful apps, right? These AVSs that will be built on EigenLayer will be using by building out useful protocols, useful dApps or whatever it is, right? And have appropriate incentivized reward structures such that like restakers, right, or the stakers that will be opting into EigenLayer, right, can benefit from, being able to secure these other AVSs. So you have the AVS developers that like, jumpstart the crypto cold start problems, reduce the bootstrapping costs and stuff like that. You have the stakers, right, that give them another avenue of yield on this, right, to be able to secure these AVSs that hopefully will have appropriate incentivized rewards and building useful applications on this, right? And then you have the validator operators like a Coinbase Cloud or something like that. We get like, a cut of these rewards being able to be delegated to this, like the restaked ETH delegated to us by adding support for these, right? Because we're the operators that would need to be able to add support for X amount of number of AVSs in the future to be working alongside, quote unquote, the ETH, the restake ETH, right? So that's kind of like the three kind of avenues to think about where, like, why EigenLayer is useful or like for many different parties in the ecosystem.
And so EigenLayer launched restaking as a protocol on Ethereum mainnet last year, but we still haven't gotten any actively validated services. I don't know if you're familiar with what the timeline of that's going to be. Is it going to be April, for example? But can you maybe just talk about the first one that's going to launch, EigenDA? Like, how does that work? And is that the template that we're going to rely on for all the other AVSs that are going to be coming in the future?
Yeah, that's a good question. And like, at least, from official docs, like EigenDA is going to probably go live in like somewhere in Q2. That could be April, May, or whatever it is, right? There's no, we know with protocol, like, launches, right? There's like a little bit of like a time in which, like, they're kind of like a range of time. So, EigenDA is going to be like that first one. And there's going to be other, like, we've been speaking to a lot of AVSs, right? A lot of them are keen to launch alongside or like very close with EigenDA specifically, right? So EigenDA, what it is, it's a data availability. Now I have a problem saying it. Data availability solution made by the EigenLabs team, right? And the idea is that EigenDA stores roll-up transactions until their computer state is finalized. So it's scalable. The idea of EigenDA is that, it's scalable, right? It's a write throughput, scales linearly actually with a number of operators participating in EigenDA. And it's secure. EigenDA specifically is decentralized and it's made up of 100 operators registered in EigenLayer, right? Where the delegated stake, to it imposes like an economic cost to like misbehavior, right? And because, as I mentioned, right, like the idea of EigenLayer is that it leverages, I probably shouldn't use that word, but it uses the Ethereum security budget, right? And to be able to use that security budget for the launch, right? So like EigenDA will have billions of dollars of economic security at launch based on the operators that are going to be running it, right? And then also EigenDA is like inspired by dank sharding, right? The idea is that dank sharding I mentioned earlier, right, is supposed to scale past like, the blobs that we have right now. Like it's proto-dank sharding. That's kind of like the step on the way to a full dank sharding, right? So EigenDA blobs are on contracts on Ethereum, which like natively subject like operators to specific slashing risks, right? So Ethereum L2s can, using EigenDA, can avoid any specific trust assumptions on any like chains like clients. So this also means that it's decentralized. So, EigenDA is like, scalable, secure, decentralized as is one of the first things. Now, in terms of the first AVSs, now in terms of like, is this going to be like a benchmark or like, I can't even think of the word right now, a template of like how AVSs will be built. I mean, there could be potentially other DA solutions built on this. And I think this goes back to what you can build on EigenLayer, where it's like, it's generalized, right? The idea is that you can build like, any type of AVS, right? If you want to think maybe like an Oracle, right? That may be secured by Ethereum's economic security. You can think about like, different kinds of categories of AVSs, some of which we haven't really thought of yet, right? And that's kind of like the main kind of like, one of the main innovations here, where it's like, well, I said, it jumpstarted the crypto cold start problem, but also there's like this idea of permissionless innovation, where it's like you could build whatever the hell you want. There are certain like avenues in which we haven't really explored yet, and I suspect there are many different like EigenLayer like categories, right? AVS categories in which we can see in the future, where it's like, oh wow, this is actually really good. Maybe like insurance protocols, co-processors and all that fun stuff, right? There are things that are being thought about right now and things that we haven't thought about. And, maybe there's some people out there definitely like, thinking about that.
Yeah. And the reason I kind of asked about this is just because, we have liquid restaking tokens. And for anyone who doesn't know, like just like liquid staking tokens, rather, there's this new layer of liquid restaking tokens are being built on top of EigenLayer, except the financialization models for these things are a lot more complicated because, obviously like, liquid staking tokens are just kind of a simpler prospect. You have to secure the network, you get paid rewards. But with liquid restaking tokens, you have a lot of AVSs that produce yield that you can gain, but you only have one token. So there seems to be a lot of trade-offs inherent in that. Can you just kind of talk us through just that prospect?
Yeah, absolutely. So, I mean, the thing about it is that let's think about just go back to staking specifically. All right. Just plain old staking. Right. When you stake like Ethereum right now, let's ignore liquid staking because we'll get to that in just a sec. Right. When you stake Ethereum right now, or just without the idea of liquid staking, right? The idea is that you lock your Ethereum for X amount of time and, your ability to participate, get your validator in there and your validator coming out of it if you want to exit is dictated by the withdrawal and entrance queues, right? So it could be some time. I know, right? Like after the merge, what was it? Like there was like it reached a high of like, don't quote me on this exact number, but I remember seeing like 50 days or something like that of like being able to stake to Ethereum, right? So it's not, the whole point of bringing that up is that it's not liquid, right? And before even the merge, right? Like, it was just like something that was just like, staked there. You couldn't move it, you couldn't withdraw it rather, right? So, when that's birthed, like, liquid stake solutions where it's like, okay, well, here's you put our stake through this smart contract, right? And this idea is that you're going to get a token back in which this is a representation or receipt of the staked ETH that you have, right? That will accrue the stake rewards, but also you could actually use this token to be able to, like participate in DeFi and all that fun stuff, right? And then you have like other solutions like, Kiln in coordinates with Coinbase Cloud, where we have a partial ETH staking solution where the idea is that you could stake any amount of ETH less than like 32, because not everyone has 32 ETH. And you don't actually get a token back. It's just a representation of the stake that is for the 32 or less ETH. You could stake more than that if you want to, but like again, like there's no token associated with it, right? So now we're talking about that because based on liquidity and like be able to use it and stuff like that, right? So now we think about AVSs, right, that are now attached to this, like the liquid stake solution, because like, let's think about it, right? The idea is that the LST, right, like, or LRT rather, excuse me, right? These liquid restake tokens or these liquid restake protocols, right? The thing about these restake positions for the AVSs, right? The AVS restake positions are not very liquid itself, right? So the idea here is that LRTs make it such that these AVSs, like they aim to make the AVSs more fungible, right? And the LRTs maintain their peg through the underlying asset through the restake node operations, right? So the idea here is that, well, you have this like LST that, like you put into a smart contract, become an LRT, or you have the LRT, right, where it's like representation of the stake rewards, but also these AVS, like, these AVS tokens or AVS rewards that may be coming from restake positions, right? So the thing about this is that like, the yield then from LRTs, right? Again, remember I said everybody likes yield, right? LRTs derive yield from many AVSs, right? So, and then we should note that like, many AVSs will probably have their own tokens. So this yield will probably come in the form of many different tokens that denominate it, right? So they're different from like, for example, the LSTs that they aggregate across different AVSs. And it's based on like the AVS, like, return rate in terms of the yield and stuff like that. So then we can think about like, for example, like, redemptions or like, how you'd be able to like look at these things, right? In terms of the redemption process, you have like, the thing is like, it may differ. It differs from the LSTs because the withdrawals depend on the AVS details, like any specific AVS details, and the restaking protocol, right? In this case, EigenLayer, right? And how that looks like, right? So like, in addition, for example, if you're trying to like withdraw from EigenLayer, there's an additional like 7-day escrow period, right? So we have to think about those things. And there's like many different like extra things when it comes to like LRTs, especially like, for example, well, if these operators are going to be operating AVSs, how does AVS selection look like, right? In maybe like in a like, immediate kind of mindset, you think about like, oh, well, maybe the more AVSs, right, that will be supported, the higher the potential yield that comes from it, right? Which is, first of all, unsafe thinking, in my opinion, right? Because we want to make sure that the AVSs, right, like are actually providing actual value, right? And how does that value look like? And how does the value accrue, especially they have their own tokens, right? We have to think about those things, like what AVS selection looks like. And right now that's all up in the air in terms of like how people are thinking about it, where it's like, okay, well, if, like this LRT is like, oh yeah, we're going to support all AVSs, or maybe just an operator, if it's not an LRT, support all AVSs. That, we have to think about, first of all, the risk factor and like adding more AVSs, where it's like, okay, maybe these AVSs are not quality, whatever it is, but also the operational lift, right, of set AVSs, right? Like if we're going to add more and more AVSs, right, there could be an operational and maintenance lift, which is also a risk factor as well. So then this goes into kind of like ideas of slashing is in the case where it's like, well, how does slashing look like, right? It's going to be different per AVS, but also slashing is not live right now. So when that will be like to be determined, right? So like there's many different like, avenues here to think about when it comes to LRTs. I know that was a very long, what do you call that, answer, but hopefully like, I could go deeper into it, but let me know what you think, David.
No, that was good. And, I think we could actually spend more time on this, but, we've gone at length on this because, I think there's still a lot of open questions that a lot of our clients have in terms of operational leverage with LRTs and what's going to happen in the system. But to be honest, we probably won't really know until these things launch. So we'll see. But no, Ben, this has been great. Like I hope you can stick around for the rest of the show because we're going to go into like some market stuff and maybe you can opine a little bit. But let's bring in George because, there's been a bit of a sea change in terms of performance that we've seen recently. George?
Yeah, thanks, David. So I would say price action was nothing short of impressive over the last week or so. We've obviously seen a pretty sharp correction down to just below 61K in BTC and in ETH just below 3,100 at the beginning of last week. And if you look at altcoins equally, a lot of the darlings had pretty significant drawdowns, most of which have been recovered since. But if you look at coins like Filecoin, Solana, Render, so really a lot of the coins that the market quite liked over the last couple of weeks or months, those were all down 20 to 40% from the peak at the trough at the beginning of last week. I think one of the things that really helped us and helped to reignite the market sort of towards the middle of last week was undoubtedly a dovish Fed, with the Fed signaling 3 cuts to come this year. I think that's one thing. And if we look at the origins of that sell-off, I think another key thing that everyone is focusing on is obviously ETF activity, and which has come to a little bit of a halt last week. Actually, we've seen just under $900 million in outflows, but then we flipped into positive territory. So $15 of inflow, $15 million of inflows yesterday. So that's been interesting to see, and I think that's going to continue being quite important for the market in the short to medium term.
Yeah, that's a good point about the Fed. And I struggle with this because sometimes I'm kind of like, I kind of think, to be honest, the timing of when the Fed cuts is kind of irrelevant for markets at this point. Like, the direction of travel is clearly they're going to cut rates. And I think the messaging that we got from this particular meeting was dot plot didn't change in 2024. It changed 2025, 2026, but that's 3 cuts in 2024. So that's fixed. Moreover, like, they kept that and they raised the growth expectation. So now we're expecting growth to actually climb to 2.1% this year compared to what they saw in December, which was around 1.4%. So the economy is still moving in that direction. And you get that question a lot of like, well, if the economy is still doing well, why do they need to cut rates? And that's because we think about real rates. We don't think about nominal rates, except when it comes to equities and stocks and trading that, because then very much nominal growth matters. But I think that from the Fed's perspective, that's what's important. And the other thing was they talked about tapering of quantitative tightening. And that's huge. The fact that they think that's going to start fairly soon. Like, I think conditions are easy, and more than likely they're just going to remain easy for the rest of the year.
Yeah, 100% agreed. I mean, on the QT tapering, fully agree there. I think it's pretty good for risk assets, and obviously we have seen BTC go straight up from 61K or so to 70K today. I think with that being one of the reasons, I guess. So yeah.
So I would love to kind of bring in Greg here, because this has had some bearing on flows here. I mean, Greg, what are you seeing on that side?
Yeah, so it's been busy on the desk. I think I have a slide we can bring up that just shows exchange volumes, and we've come in a bit from where volumes were when Bitcoin was last at 70,000, but we're still elevated. The interesting thing that I would note is, during sort of the sell-off, I'll call it, our desk was pretty much skewed to the buy side in almost every token. We were a little more balanced rather in some of the altcoins as folks traded around some positions and sectors there. But I think the overall sentiment is the initial move happened so fast that folks felt under-allocated. The pain trade we've talked about is higher. And so we saw a lot of traders and investors using that sell-off to basically up their allocation.
Yeah, like I think that's interesting because, I think the conversation around whether these ETF flows have stalled, whether they're coming back, I don't think it says anything about the real interest that's kind of waiting out there. And by the way, like, just as far as, and I know we may talk about the institutional, but on the retail side of things too, like, I find that a lot of retail investors were just underpositioned for the rally that we saw last year. And now they're kind of chasing this market. And there's still another $6 trillion sitting in money market funds with rate cuts about to happen. I think that for me is like the big message that I would kind of get across in terms of what we're going to see here. But George, any other like big headlines that we should be paying attention to in the space?
Yeah, so I mean, a couple of things I was watching over the last week. Obviously, we've discussed Dencun with Ben at length. I mean, if you look at some of the TVL changes, I mean, that's quite impressive. ARP TVL is up 11% over the last 7 days. Blast TVL up 14% to $2.7 billion. And I think base actually what was shining very brightly here. The TVL up 83% over the last 7 days. So that's now battling with Blast for the third spot, sort of in among the L2 protocols by TVL. You mentioned Sol meme coin, so that frenzy is still not stopping, and seemingly, we get dozens or hundreds of new coins coming out of nowhere, so to speak, every day, and reaching market caps of tens of hundreds of millions of dollars pretty quickly. So that's going to be interesting to see, how sustainable that's going to be over the short to medium term. In terms of other news items, FTX sold a part of their stake in Anthropic. So about 2/3 of the stake for $884 million. That's mostly going to UAE-based investors, which was quite interesting to see. One other thing that was flagged looking at on-chain data was an unidentified Bitcoin address, moving about $6.5 billion in BTC to 3 new addresses. So that address was funded with 94,500 BTC in 2019. We then had the Polygon ZK EVM going down for more than 12 hours, but it didn't really have too much of an effect on Matic, or the Matic price rather. And lastly, I think some super exciting news from BlackRock, who are now using Ethereum to launch BIDL, which is essentially a new tokenized fund. And at the same time, actually, timing was interesting on that. We have the ETH Foundation that is now facing a regulatory probe. But again, it hasn't really harmed ETH price action-wise.
Yeah, that headline was super vague, by the way. It gave like no details, and I think it's just very speculative how people are trying to read into that. So, the fact that like ETH is holding up well here, I think speaks volumes about it. But let's kind of like end all with futures. Greg, can you talk us a little bit about funding rates and what's going on there?
Yeah, so we talk about funding rates all the time, every week on this call. But we talk about them so much because they're important. And basically what we saw was, again, from that sell-off until right before the Fed kindly turned us around, we saw funding rates in the perp markets come in from as high as 60, 70% in Bitcoin, down to sub 20. I even saw 15 on my screen for a moment there. And what I mean by 15 is, so somebody would have paid 15% annualized to put on long exposure in Bitcoin. And that's been generally lower than it's been during this past bull run. And that's a good sign. What it means is people aren't, or at the time, weren't overpaying for leverage. As the markets kind of rallied back up towards 70, we have seen funding rates creep back up. They're right now around high 20s, low 30s. But given this run, I think that's a very healthy spot. I would again start to get concerned if we start to see the funding rates of the majors north of 50% again. That to me is when we're getting a little overextended. Doesn't mean that it would necessarily cause a sell-off, but it does increase the risk of one.
That's super interesting. And we have been looking at the long short ratio. I don't know if you pay attention to that too much, but it seemed like sentiment was super high, like just last Friday, and it was like teetering at levels of like 1.7. It came down pretty quickly, actually, and it came down now, I think, like to the 1.4 kind of levels. Usually 1.5 is around like the equilibrium rate. So I'm kind of cautious about how we're kind of playing these markets. I don't know if like that's if that's how you're feeling at the moment.
Yeah, so I didn't know that ratio existed until you had pointed it out. And so just for some of our listeners, certain exchanges perp exchanges will basically show the ratio of net long positions to net short positions. And it's just another indicator that you can use to determine, how bullish or bearish the market is. So I haven't used it very much just because I didn't know it existed, but it is definitely, I think, a useful data point that we'll have to incorporate, into our views. But generally, I think it's funny, like what's going on in crypto is in a way similar to what's going on in more traditional markets, where you're getting kind of this, I don't want to use the terms it's been used before, but everything rally. Stock market volatility is very low. Almost every day we seem to eke out another 50, 100 basis points in the stock market. Credit spreads are very tight. It's priced to perfection, as some might say. I think we're seeing a similar market in crypto every day or nearly every day, with the exception of a few sell-offs here and there. We're seeing higher token prices. And it's one of those things, especially in crypto, such a momentum-driven market. At some point, it will end, but everybody that I speak to feels like we're still very much in the early innings of this.
That's a really good point. Like for the most part, almost everything's kind of rallying. And if you just happen to be positioned in markets just as a whole, whether that's an equity or crypto, like you're not a genius. It's just that you're benefiting from the environment as is. But I mean, it's great because like you need to kind of be positioned in here because otherwise you're going to be missing out. Anyway, I think with that, let's kind of wrap up. Everyone, thanks for listening today. Thanks to Ben for joining us, Greg and George for sharing their insights. Ben Floyd will be back with us next week, so you won't have to suffer from my moderation kind of inefficiencies. But thanks, everyone, and tune in next week.